Yes, hello folks. Yes, this is Blue Sky Forex Academy. Yeah, and today we have come to talk about the psychology behind LXG concept. The psychology behind LXG concept. Yeah, and the one talking to you is like an XA UG. And let's dive in deeper. Yeah, and yes, this is what we're going to be talking about today, the psychology behind LXG concept. Oh, the building up points that come up with the LXG concept, and that's the theme. And the sub theme might be advanced directional bias, on how we know the way how the market plays out. Yes, advanced directional bias on how to tell where the market is heading. Yeah, and what does that? And those are the time frame cycles, because time frames are the ones that create a structure on the market. Yeah, because structure can't print itself by its own. The main psychology, it's about time frames. They are the ones that are behind those structure moves, and we're going to talk about that today, on how the market plays out, especially on this advanced directional bias, but mostly uh, are based according to our LXG concept. Yes, mostly based on our LXG concept. Yeah, and the person talking to you is like an XA, like an XAUG, the original one. Yeah. So what are we going to talk about today? Like, firstly, we shall talk about, let us dive in deeper, we shall not waste time. What are we going to talk about today? Let us talk about what we all mostly know. It's trend. It's the trend. And remember, the market always moves in trends. If it's not a bullish trend, it will be a bearish trend, because the market has to have a direction where it flows or go. Now most of us know this, that the market has directions where it is heading, and now the problem is on how to join these trends, how to join the trends. That is the way how most people fail to find productivity in this game, because they can't find ways of joining the trends. But we are going to simplify this today, and mostly this is based upon LXG concept, part 2 of our series. Yeah, part 2 of our series. And what is a trend? I think you all most traders know what is a trend. Yes, I will define trend in my own analogy. Trend is something I might call that has been moving for a long time in the same direction. It's trending in the same direction, as in one direction. Now this can be called a bullish trend. That can be called a bullish trend because it is trending, it is moving in one direction, or making higher highs, higher lows, higher highs, higher lows, making higher highs, higher lows, trending in one direction. Yes, and this is a bearish because it is making lower lows and lower highs, lower lows, lower highs, lower lows. Yes, it is trending in one direction. Most of you guys know that. So, how do we approach ours here on the LXG concept? How do we approach the trend phase? We approach the trend phase on how to find the trend, mostly looking for this guy, area of liquidity, or this might be still called the break of market structure. The break of market structure, or one can call it recent area of liquidity, or recent break of market structure. Yeah, here we are trying to define the trend, because we have two approaches on the market, whereby I'm going to mostly explain one, and that is using validation and invalidation phases. For a simple structure, this is a break of market structure. One can either call it area of liquidity. Yes, and the validation and invalidation I'm talking about, this is the validation, this is the invalidation. This we can call it higher high, this is higher low, this is higher high. This is the recent break of market structure we have. So this point, it is the validation. It is the validation. And this point is the invalidation. Why am I calling it the invalidation? Because if structure violates it, this trend that has been heading in an uptrend will change if we violate this level, meaning that this trend, it will change. But if we stay in perimeters of this level or above this level, we shall still be in bullish sentiment. Even though it comes deeper, it will still continuously move. So with that said, yes, now we know the area of liquidity or break of market structure. What you have to do when you arrive on the chart, you have to look for that recent break of market structure, or that recent area of liquidity that is made in either any of the direction. It might be bullish, it might be bearish. And now if you see that structure, what are you supposed to do next? Yes, after seeing this guy, let me say in one of our time frames like constant, these are time frames that don't change rapidly. They don't overchange. But any time frame can be your constant. And what do we or how do we get this constant? You have to look for a time frame that doesn't overchange from the time frame you're using. Let me say you might be using M30 as your constant, and you're an S5 or M5 as your situation 1. So meaning your M30 will be your constant because it doesn't overchange like M5. M5 might be in a bullish direction and it changes to bearish, and now it changes to bullish again. It is very hard to see M30 doing this, being bullish, changing to bearish. Yes. So let us say this is our weekly break of market structure. Yes. After you saying this, what next do you have to do or to look for? This is the weekly breaking structure for us, or making a break of market structure. So what's next? Most people get confused here, as I explained in one of the previous videos. And remember, this is the way how the market moves. So we see markets or pairs retracing back in these zones. How can you know? How can you tell that the market will retrace back? We have time frames that do that for us. If this is weekly breaking structure for us, which time frame do you think will make the retracement back in the area of liquidity and still make the continuations? And if this is weekly, that time frame will be daily, because it is just the time frame below weekly, meaning this is our constant. It doesn't overchange the weekly. And situation 1, it is the time frame you're supposed to head to below, because it is below weekly, or it is below the constant you've used by now. So meaning daily has to break structures, or has to form its own break of market structures heading below. Heading where? Below, inside this area of liquidity made by weekly. And a simple true hack: if daily doesn't break structure heading into this area of liquidity, chances of buying are still low. Even though it comes back to your point where you want to buy from, how? Then there it will come back impulsively without breaking structure. If it comes back impulsively like that, those people thinking of buying, I think you might think of reducing the risk, because it's not yet in favor of buying. But if it comes back while breaking structure, this is daily, then you have more chances of it coming back to where it wants to buy from. Then it still buys back to this point. Okay, that is what we are going to talk about today: the trend, the retracement, and the continuation, because that is the way how the market plays out. You arrive on the chart, you can either go in any of your constant time frames. Yeah, this is our time frame coordination. This is how you can tell constant time frames as I designed it. So these are the constants. They don't easily change, as you see above here. As I told you, constant time frames don't easily change. So when you arrive on the chart, it is mostly favoring for you to look for break of market structures in either of these time frames, in any of the directions the market is heading. Looking for break of market structure with candle closures above the previous weeks here. Candle closures. The candle has to close above the candle wicks here. That is a confirmed break of a structure. So you have to look for the recent break of market structure in either monthly, weekly, daily, H4, H1, or M30. After you receiving that break of market structure, The time frame you're supposed to drop back to that will make that retracement, it will be this S1. It will be the S1. That is the time frame that is supposed to make the retracement back to you in either of this area of liquidity, maybe of daily. Let us say this one, daily. And now the time responsible to make the retracement and the continuation, it is H4, as you see here. Let me put this right. This is going to be our constant. This is going to be our time frame responsible for the retracements and the continuation. Let me assume we have got this area of liquidity of daily with candle closure above here, above the wicks we have here. Now the time frame responsible for the retracement, that is H4, our S1 time frame, it is supposed to break structure. It is supposed to break structure. It is supposed to break. You see this high? Let me put it in another way. Most times, let me say we have this, and you might call this one your high, your low, and you call this your extreme high. And most people when they see this, when they head to maybe H4, you can go on your constant time frame and perfectly you find this break. Yes, now this is daily. You've got your recent area of liquidity or your recent break of market structure in daily. Then you head in H4. When you head in H4, you might find structure like this one. Just for simplification, you might find structure like this one. This is your high of daily, this is your low. Now this is your extreme point that was made by daily, and you have this small structure inside here. Most people consider this as a retracement phase, but this is wrong. This is so wrong. This structure you're seeing here, you're trying to base on, that is daily structure. That is daily structure. You don't have to base on daily structure when you have to wait for H4 structure. What do I mean? If daily breaks for us structure, this daily has broken for us structure. Now we are waiting for H4 to break for us structure in an inverse direction or as a retracement phase. H4 has to break its own structure. Now, like from this high, you have to head in H4 after seeing this. You have to wait for H4 to break its own or make its own break of market structure. Not waiting for this daily has made its high. Now H4, it has come back here and it has broken this. Now you're trying to refine this for entries. You want to sell. That is wrong, my guy. They will they will sweep you. You will become liquidity in the market. That is not right. I'm sorry of laughing, but that is not right. Yes, you have to wait for H4 to break its own structure. You have to wait for H4 to break. Even though it does this, don't be impulsive to enter. You have to wait for H4 to break its own structure or make its area of liquidity, whereby it is this low, this high, and this one. This is a break of market structure here. Now here, you have to be well convinced or some guarantees that the market now will push back below into this area of liquidity of daily, and it will buy back to this high. But after receiving H4 breaking its own structure, not one of these daily. Yes. With that well explained, let us go back to our our clean chart. Yes, as I've explained to you, we use the daily. We use daily as our constant time frame, or the time frame that doesn't overchange. This time frame will give us the trend or the direction where the market is heading, and the time frame that is supposed to make the retracement back below in the area of daily, or the area of liquidity of daily, that is supposed to be H4. And H4 will be supposed, or will be responsible to make for us the retracement and the continuation back into the area of liquidity of daily, and back to the high of daily that was made. Yes, this one, it is daily. H4 is responsible of coming back into this area, and is responsible of taking us back high to this high of daily. Yes, and as I have told you, if daily breaks, H4 has to also break its own, showing that now it has finally decided to retrace back. If you come and find daily has done this, and maybe there is news or any impulsive move that has just retraced back below into this area of liquidity, and maybe it has reached your zone where you want to buy from, please don't be impulsive on trying to buy that move, because there are most chances that that market will sweep you out. Why? Because H4 has not confirmed. After you receiving this break of market structure of H4, it gives us confirmation that the areas where you will want to buy from in daily will hold. If you receive this break of market structure to the downside, that is one of the confirmations that the areas where you want to buy from in daily will hold. But if you don't find that break of market structure of H4 to the downside, then there will be chances that those areas where you want to buy from in daily will be violated. Now let us shift this analogy to a bearish side. This is a break of market structure of daily to the bearish. Make sure you find this area of liquidity or recent area of liquidity that has been made by daily or any constant time frame as we saw them on the other chart. Then you're supposed to wait for the S1 time frame, or the time frame next to this time frame that has made the break of market structure, to break for you its own structure, showing that now it's in the retracement phase. Yes, and now if you see that, just know that this market is going to retrace back into this area of liquidity to either continue the buys, or still to violate it, because it is also possible. It is also possible if what you want or what you are waiting for in this area fails to play out, they can still break it, because prices are fractal. Yeah, prices are fractal. So you have to wait for this break of market structure, confirming for us that these areas here have high chances of holding, that the market will still push back to this side. So now we are talking about continuations. This is daily break of market structure. H4 has made for us. It's breaks also. Now we are back inside this area of liquidity, and now we have reached maybe our points where we want to buy from. or liquidity engineering on maybe this low or this high. It has given us liquidity engineering. Yes, we have our liquidity engineering zone. So now what is the time frame responsible for the continuation? H4. Now let me say this is the recent structure we had. We have to wait for H4 to also make for us those break of market structure now to the upside, now to the downside, sorry, to the downside, because our target it's below. Now you see that H4 has shifted, making that break of market structure, now showing to us that now it might want to continue back to this low. And now that is how the market moves. If you can reflect the real market, that is the way how the chart or the market plays out. It will form for you that phase in the constant. It will retrace back by a specific time frame, and it will reach a point and it will start pushing back above. Yes, it will start pushing back above. So on closing up this video, yes, I don't want to exceed 30 minutes. I don't want to exceed 30 minutes. You have to know the recent break of market structure in the market, either in either of these constant time frames, monthly, weekly, daily, H4, H1, or M30. But a simple hack or a disclosure to you, you have to mostly look for monthly, weekly. Yes, these are the main constant time frames you have to use, but you can still also use these ones below. You have to look for the recent break of market structure. After you heading for that break of market structure, you've seen it is maybe in monthly. Now the time frame responsible for the retracements and the continuation, that is S1, which is weekly. Weekly will be responsible for the retracements back into this area of liquidity, and it will also be still responsible for the continuations to that high of monthly, to that low of monthly, because this is a bearish structure. So this has been Lycan XA Uganda with you. In this video, you can screenshot this chart time frame coordination main framework. This is the work that guides the market structure to form. If you mostly face the market structure and you don't know more about the time frame coordination, you will face a problem, because time frames are the one that form the market structure. So if you can tell the time frames properly, the market structure will become easier or easy for you. Yes, the structure will become easy for you. So today we have talked about constant and situation 1. This one establishes for us the trend or the recent break of market structure in the market. This one, S1, is supposed to give us the retracement and the continuation, the retracement back in the area of liquidity made by constant, and now it will still make us give us the continuation back to the high that is either made, the high or low that is either made by the constant. Next time we shall talk about this liquidity engineering. So I sign out as Lycan XA AG.